Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's October 4th, 2019. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for joining us this week. This episode, we have a special in-house guest appearance from Real Vision contributor and Credit Writdowns letter writer Ed Harrison. In our second part, Patrick and I dig a little deeper into the IVOL ETF without the pressure of the product's founder on the other line. In our Tales from the Trading Desk, we remember Soros' worst trade.
And in our WTF segment, we ask Kevin, what the And in this week's trading history, we go back to 1886 for the Guinness IPO. And then we'll end it with the top 5 things to watch next week. So we're going to jump to our beer sponsor. Now, Lena normally comes on here and features the whatever sponsor has decided to sponsor the show. We had to kick all the sponsors out one extra week to bring in it was actually
it was a scheduling nightmare.
It was a scheduling nightmare.
We had to phone all the sponsors and tell them we had to go
exactly.
one extra week.
Why?
We managed
but
to
why?
Do it.
We managed to do the why, and that's because we're going to feature the Guinness IPO in our This Week in Trading History, and in honor of that, how could we not be drinking Guinness for that featured beer, because it's an absolutely delicious beer. I know what I'm about to experience. But so this week we're doing Guinness Draft Stout.
Why don't we invite Lena on, even though we're not Lena, hop on.
Lena, do you drink Guinness?
Oh yeah, it's a meal in a pint.
Mm-hmm. Mine's been in the back of the car and is about 72 degrees.
Oh,
that's gonna be interesting.
It's like a cup of coffee. Yep, that's exactly what I love. All right. So, Kev, why don't you give the disclaimer legal stuff?
Yeah. You know what, I would, but my Guinness is all over me. Okay, clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much market huddle may include pig summer shave, icy sneeze, and or crazy migraine. Okay, at this point, usually we kind of jump to our guests, and I just wanted to give everyone the heads up that we actually taped this interview with Ed Harrison on Thursday night. It ended up being that my scheduling conflicted, and we couldn't do it on Friday with Ed, so we had taped it early. We just want everybody to know, because in the interview, he talks about the unemployment number, and it is actually, at this point, the number has actually been released. So without further ado, here's our interview with Ed from Thursday night. We now have the pleasure to joining us in studio is Ed Harrison, a Real Vision presenter and the author of the Credit Writdowns newsletter. He's flown all the way to Toronto to join us at the Huddle, and welcome aboard.
Thank you very much. It's good to be here.
Yeah, no, it's great to have you. So let's get to it. There's lots happening in the markets, a lot of excitement. It looks like the market is finally a kind of accepting that maybe the recession, or at least an economic slowdown in the U.S. is upon us. What do you think?
Yeah, so I think that the data that came out today and yesterday, or actually specifically yesterday and today in terms of the ISM and the PMIs, they were pretty terrible. Both the ISM for manufacturing and for services were terrible, and then the PMIs from market came out, and they were also kind of negative. Like the composite composite PMI from market was something like 52. So we're definitely looking at a very serious situation. Meanwhile, you have the Chicago Fed with Charles Evans coming out and saying, you know what, actually, we don't think that we're going to necessarily do anything. You know, the economy is doing okay. And then tomorrow we have the jobs number. So we're sort of at a critical moment. The question is whether or not the Fed is ready to act in some capacity and whether or not the economy continues to sink. I think the jobs number tomorrow will give us a good read on whether that's going to happen.
So if the job number is bad, or at least confirms what we've had with the ISM, we have the Fed pricing in an October cut, or at least the Fed funds futures market pricing in an October cut. Do you think the Fed will follow through and actually cut in October, which would be a non every 2 month cut, right?
Yeah, I think that they will follow through. I think it was a 65% before the data came out, and so maybe it's gone up beyond that. And basically, the Fed is loath to disappoint, so they will come through with that particular cut. But then the question becomes, what's their language? How many dissents do they have? And what are they positioning the market for going forward? And then how does the market react? Because let's say there are 3 dissents, which there probably will be, just like there was last time. There might be 4. If there are more than that, especially if it's on the hawkish side, let's say Evans joins Rosengren and George and dissents on the hawkish side, then the market's going to throw up potentially, and you're going to see bonds rally, maybe even equity sell off. It's going to be very interesting this next meeting in this month.
So do you think there's almost no chance that the Fed gets out ahead of the market?
No, I think that the Fed, because yields backed up enough after the summer swoon, they feel they have enough runway in order to soft pedal their future hikes or their future cuts. I mean, they really don't want to cut. Really, when at the end of the day, they're not saying it explicitly, but they know full well that all of these additional policy measures that they have aren't really very good, and they only have 2% of runway. So after the 2%'s over, what are they going to do? Are they going to start doing QE out the yin-yang? Are they going to start buying mortgages? I mean, there's only so much they can do, and they understand that that's the case, and so as a result, they're trying to keep as much ammunition in their back pocket as possible.
So, Ed, I have to ask you here. I've heard a number of people say that they're thinking that QE4 is coming here in the fourth quarter of the year. Do you think that what's your over/under on that possibility happening here in the coming meetings?
I think that if the data deteriorate further from here, if we see sub 1% GDP growth numbers over a 6-month period, it would happen. But let's just say, we had 3.1, we had 2.0% in the first 2 quarters, that we get a 1.5 and say a 0.5. That's enough, 1.5 for Q3, 0.5 for Q4, for them to start saying, okay, we're going to take what was a increase that we're using on the repos just in order to increase the reserves, and we're going to turn that into a real QE. So I think that they could do that if we see those kinds of numbers.
So, but that would be unusual because we would have QE before we've hit the zero bound, which wasn't the case before, right?
Right, that's right. And I think the reason that I could see them doing that is A, they already have the repos that are out there because they have to increase the reserves. And B, they don't want to run out of ammunition. They're really very afraid that if they were to run out of interest rate cuts when they really need it the most, then it could be bad. And we know if you look at the QE 1s, 2, and 3 in the last decade, what happened at every single juncture was actually yields went up, because the yield curve is mostly determined by the consensus view of future policy. It's not a supply and demand thing where the Fed comes in and yields go down. Actually, they go up because people are saying the Fed has our back. As a result, the economy will do better, and so yields go up in anticipation of less, of better policy going forward, better economy going forward. So I think that they're hoping that they could do that with QE4.
Well, Ed, you're just you're preaching to the converted there, because I've long argued that QE is by its very definition supposed to be inflationary, and what is a long bond investor's worst nightmare? It's inflation. So if QE is effective, it should cause the long end to sell off. You mentioned the repo market. There was the kind of repo gate or whatever it was a week and a half or 2 weeks ago. What's your thinking behind what caused that? And was it a signal that something is broken in the plumbing of this market, or was it just a case that they were caught a little unaware and it was technical in nature, like the New York Fed is claiming?
Yeah, I think that since we haven't really seen a lot of action on that in the time period since they were caught out with the repo markets, that likely their explanation, the New York Fed, is the right one. I mean, what happened pre-excess reserves was that the Fed had an interest rate that it needed to set, and when it set that rate, it needed to supply as many reserves as necessary for the banking system, given the loans that the banking system was making at that rate in order to keep the rate at that level. If the Fed refused to supply the reserves, they would break the market. They wouldn't be able to keep that rate. So in order to keep the rate, they basically, as a monopoly supplier of reserves, can only do one, have a rigid rate, but then they have to accept a floating amount of reserves as a result of that. The monopoly supplier can only control one variable there. So now they have all these excess reserves, and they forgot that this is the regime that they were in. And as a result of that, we hit what I would call the level that we were before much earlier than they anticipated, because there are lots of regulatory requirements on top of the reserve number. So if you looked at it strictly from a reserve requirement perspective, you wouldn't expect that reserves were short. But there are a lot of other things that are going on in the plumbing of the system that happened since the great financial crisis in '08 that say that now we're short reserves. And so now that the Fed understands that we are short reserves, they're going to supply those reserves, and the whole repo problem is going to go away.
And okay, so let's just back up here a little bit. You're explaining a situation where the Fed's figured out the repo, they've got that all fixed up, but yet you think that they're going to be behind in terms of rate cuts. They're at least not going to jump out ahead of the market and go out and try to get ahead of the cuts that the market, the Fed futures have priced in. Do you see a situation where that is going to be a risk-off environment and equities could have a significant hiccup then going forward?
Definitely, just as we saw in December. I mean, if you rewind, let's go back all the way to 2015-16. So in 2015, Janet Yellen said, we're going to hike. And as I recall, if you looked at the dot plot, they were talking about 3 or 4 hikes in 2015 or in 2016. So then the data just were terrible. The oil markets were imploding, and they took all those hikes off the table. Then they came back, and then they started to hike again. So all along the way since 2015, the Feds wanted to hike. They've been looking for excuses to hike. The Fed in 2018 actually said 3 hikes were coming down the pike, and they instituted 4. They accelerated their timetable with the December hike as the 4th hike that they didn't say that they were going to do in the beginning. So when they did that in the face of bad data, the market threw up. We had a huge problem. It imploded, and then the Fed had to backpedal. But even after they started backpedaling, they were soft pedaling their backpedal. You know, they have never gotten out in front of the market. They've always been forced to relent. The market has led the Fed into the position that they're in now, and that's going to be what's going to happen going forward, in my view.
And so will that manifest itself with a stock market that really has like a severe crack? Like, are you thinking that this is something where we could see 10, 20% and like something as scary as, December of 18 when we got that kind of liquidity pocket?
Yeah, I think that we could get December of 2018, but that's probably the max that you're going to see in a non-recessionary environment. I think that a recessionary environment is where you see the real downside. If you looked at the last 2 or 3 bear markets, you have to go back to the early 90s and Saddam Hussein to get a bear market that wasn't like 40, 50% down. Every single bear market since then, 2001, 2007, 8, and 9 were 40, 50% declines across the board. So if we have a recession, I think that's going to be the scenario that you're going to see.
Okay, so I'm going to put you on the spot, Ed. Are we going to have a recession?
My call right now, this is how I put it in the Credit Writdowns newsletter. If you look at the data, just straight up at the data, nothing in the data are saying recession is going to happen. Even if you look at market indicators of recession, like the spreads on twos to tens, it's not saying recession. The Fed, the New York Fed, uses the 3-month to the 10-year, but I look at the 2-year to the 10-year, and that hasn't inverted. It hasn't inverted once. And usually, when it does, you have a 6 to 18-month lag before you have a recession. So really, the macro data, the market data, none of that is saying recession. However, I think that the policy mix and also the uncertainty involved in a lot of the externalities like the trade war, China slowing, et cetera, say that we could, late in 2020, have a recession. But I don't see a recession in 2019. I think that, and I've said in the Credit Writdowns newsletter, that we will have my bet is that we will have a recession in 2020. So I'd say that's the base case.
So Ed, that means that you're making the call that we're going to get into the next presidential election without being in a recession. Is that a fair way to assess your view right now?
Yeah, I think that to the degree that we have a recession, it's going to be towards the tail end of the election cycle. But, slowing into the election cycle, into the actual election, or potentially even a recession right then and there, is really going to have a negative impact. It's going to negatively impact Trump if he's the nominee for the Republicans, which, by the way, is looking not as 100% as it did before.
And so let's talk a little bit about China. What do you think is going on there? And do you think that Trump's policies are having a bad effect as the China kind of hawks are trying to portray?
Yeah, my view on China is that the growth levels that they had from before are unsustainable, that the policy mix that they had, which was heavily industrial, heavily based on infrastructure, was not sustainable. And as they've tried to move away from that mix, they've gotten down. Their growth has come down. And I think that it's never going to go back to the levels that it was before. They're just too large an economy to sustain that level of growth over the longer term. So all of the downside that we've seen, or a large majority of it, is what you would expect to happen. And only at the margin is what's happening with Trump impacting China. China's such a large economy that it's hard to believe that those tariffs are going to have, 1%, 2%, 3% of GDP types of impact.
So your argument is that that this was kind of going to happen anyways, and that Trump just kind of maybe pushed it along a little, but the reality was China was headed this way anyways.
Exactly. And it goes to the vulnerability. When you talk about I saw Ryan Avent, who I believe is still at The Economist. He had a tweet storm today, and he was talking about the exact same thing with the United States. He was saying people were talking about trade wars as being the death knell for the United States to cause the next recession, the one that I'm saying is a base case for 2020. They're not looking at the reality. The reality is the United States is the cleanest dirty shirt. It's much worse in Europe, and the declines are greater in China. And what's more is it's only at the margin. That is that you're seeing real economy slowdowns, and you're looking at something that potentially could, at the margin, be the tipping point, but it's only a marginal impact.
Do you worry about the fact that it seems like that view is consensus and that everyone's already piled into the U.S. assets, and that even if they are the cleanest dirty shirt or the cleanest shirt in the laundry pile, that it's priced for perfection and that there's inevitably they will disappoint?
Eventually, there's going to be some sort of mean reversion, if you will. I don't have a strong view on that. I spoke to a guy when I was on Real Vision. He's a German investor, and his point was that if you actually look at what's in the S&P 500 versus say the DAX or the Nikkei or even the Euro stocks, if you're taking a look at European-wide assets, and you take a look, you'll see a lot more growth companies, technology companies in the S&P. And if you adjust for that mix, what you find is that the U.S. is not overvalued relative to these other indices, that in fact they're pretty much the same, especially when you're looking at large diversified global companies, the Nestle's of the world versus the equivalent in the United States. And so, the concept that the U.S. is overvalued, he's saying is not correct. And so I think that's an interesting point. I can't really say I don't have a view on that, but I think that that's something that's in my thinking. It definitely gives me pause about the reversion to mean that I think could happen.
Right. Based upon the scenario you're kind of envisioning over the next year, what is the one trade or the one opportunity that you think that the market is underappreciating or mispriced?
I think they're underappreciating the what I would call the pension grab. That is the grab for duration. So what I think is going to happen is if we have a recession or near recession, or the markets force the Fed into capitulation on rates, that what you'll see is a rapid drawdown like we saw in Germany and in the Eurozone. That is that pension funds in the United States will understand that if they want to meet their actuarial hurdles, that they need to go longer duration. They're gonna be like, holy, I don't know if I can curse, but holy cow.
Yes, you can.
Yeah. They're gonna be like, holy shit.
There you go. That's better.
The convexity in this curve that we just saw is meaning that my whole portfolio, the duration just shortened tremendously as a result of the flattening of yields further out. I now have to buy. I have to buy more than I thought I had to buy. And this is something that the German investor who I was talking to, Philipp von Dran, was talking about. He said the last 150 basis points, the convexity in that part of the curve caught out the entire European pension companies. They had no idea how much duration shortening they were going to get as a result of that. And as a result, they were almost forced to buy.
Well, there you go, Patrick. Ed's basically in your camp. He's a raving bond bull.
Thank you very much. Because he's a very smart guy.
Yeah, he sounds like he's Raoul Paul bullish. That's how bullish he is. Anyways, Ed, thank you very much for joining us. Why don't you tell us a little bit of where people can find more about you and your great letter, the Credit Writdowns?
Yeah, so they can go to creditwritdowns.com. I would say about 4 out of 5 of the newsletters that I write are paid, but 1 out of 5 is free. They can sign up on the site, get one of the free. If they like it, they can go to the paid version as well, where you get more insights on a much more regular basis.
Well, great. Thank you very much for joining us, and make sure everyone stick around where you get more of Ed in the after hours.
So, Kev, that was a great interview with Ed, but we want to move on and circle back to when we had Nancy Davis from Quadratic with her IVOL product on a couple of weeks back. And we wanted to really kind of take a deeper dive into this now that you don't have the pressure of the founder on
breathing down our neck.
Exactly. So that way no one can correct you if you're wrong.
That's right. So we're both big fans of the IVOL product, and we were trying to let Nancy have her tell her story. But one of the things that I'd like to do is dig a little deeper into it and understand where it might not suit somebody like me. I know you're a big bond bull and you have no problem with the entire product, but I have kind of some not issues, but I have some concerns that over the long run, owning tips might not be a good kind of a part of the exposure. But anyways, let's dig into it. Let's talk about it a little bit, and let's go through it. So here we have the actual holdings of the IVOL product.
Right.
And as we talked about a couple of weeks ago, we noticed that 87% of the product is actually the Schwab ETF for the tips kind of
86.29 to be specific, sir.
right. So, well, and so
Yeah.
what you need to realize is that a good part of the IVOL will simply replicate the SCHP. And let's pull up the chart of that.
Yeah, sure. And so that right there is just the here's the chart right here. And
So you'll notice that this has actually rallied quite hard along with the entire bond market.
yeah.
And my concern lies in the fact that if we get a increase in inflation, we could see a scenario where the bond market backs up and this part of the portfolio actually declines. Now, Patrick, I know you have the opinion that inflation is never coming.
Oh, yeah. Putting words in my mouth. Okay. One day it'll come. I just think you're way too early. But anyway.
Anyway, so I just want the first thing we kind of I'd like to talk about is the fact that one of the suggestions that I have that is, if you're looking at this product and you're thinking that, hey, that those steepener options, which is, let's go back to the holdings.
Yeah.
We talked about the 87% is the tips, but there's that other 13%, which is basically the long yield curve steepening options.
Right.
If you want to get exposure to solely that part, which is what I am so kind of attracted to, because those are products that you can't trade on a listed market.
All right.
Those are institutional products that you need to have an ISDAs. Yeah. And so, and not only that, you have the great team at Quadratic actually managing that and making sure that you're always long a certain amount of gamma, and they're actively trading and kind of taking care of that side of it for you. So to me, that's really the most attractive part of this product, is that 13% of those yield curve steepening options. They're cheap and they're unavailable through regular listed means.
Right.
So for me, what I'd like to do is I kind of look at this and I say, okay, I can
That's
buy
you right there in
100.
the picture.
Yeah,
there.
that's me and the orangutan. I can look at this and I can buy 100 cents of that product and hedge out the 87 cents of that ETF, because that
Right.
the Schwab ETF, because it's a listed product. And what I will be left with is basically the stub of the portfolio of the options that the Quadratic team trades.
Now,
and
would
to
you-
me, that is
is
just like awesome, and that's what I want exposure to.
Now, are you actually just going to take a certain amount of the futures, or are you going to just literally short the ETF? Just
Well,
go-
so for me personally, I'm going to take it one step further, in that if you think about what is in that portfolio, it is a Schwab ETF on tips.
Right.
And you think back to what I actually want exposure to is two things. I want inflation break-evens and I want curve steepening. So this obviously gives us
and
one
bond volatility, right?
Yeah, so there is it's actually volatility on the curve, but that's it's long volatility, because she's managing this not by just going out and getting long the yield curve spread. She's actually buying options on that yield curve spread.
Right.
So going back to my thing, my two trades that I want long inflation break evens and I want long the steepener. So the steepener is taken care of, but the inflation break-evens aren't taken care of. So one of the ways I can make the inflation break-evens, instead of buying a specific tip and actually going out and shorting treasuries or treasury futures against it, I can buy the IVOL, figure out the amount of embedded tips in there, and then go calculate the duration on that and short the equivalent amount of futures.
Right. And I
So
think
that is
the
actually how I'm
duration's
playing it.
what, like 7.5 years or something on these tips?
So that's actually how I'm playing it. I'm going long IVOL versus short treasury note futures.
Right. And so someone as a retail investor that wanted to put on the same trade just could go, obviously you have to carry the margin, but you'd have to go short the Schwab ETF itself.
Or they could, if they
against-
wanted to do the same thing, they could do IEF, which would in essence be the 7-year treasury. and then they would have the same trade as me, which it would be long inflation
But if
break
you look
evens.
the correlation here, I'll just put the IEF up against the SCHP, and you can see here the IEF's actually been quite more volatile.
Because that's because we had a situation where inflation break evens are moving all around.
Right, but all I'm saying though is that shorting the actual SCHP will give you more accurate, because that's actually what you're holding, as opposed to if you short the IEF, you're going to have some tracking error, right?
Well, no, because at that point you will be long break evens. If you wanted to only, if you didn't want my break even trade, then yes, you could just go short the SCHP, and you would in essence be just long the option portfolio. Right, which would be in essence,
which
a
is
steepener
still
trade.
If somebody just wants to put on the pure steepener and not deal with break evens at all, you would just do that way. Yeah.
And the other thing is, if you believe, and this is I don't want to put words in Nancy's mouth, but I suspect that at her heart she's a little bit of a bond bull like you, and thinks that the Fed is going to be lowering rates and doesn't see that much to worry about in the U.S. bond market. And if you believe that, then and you believe as well that the curve is going to steepen and maybe also at the same time create some inflation, then you might find that this is actually the perfect instrument for you.
Yeah.
Because in that environment, you have tips outperforming, which is what you're going to be long. Right. You also have a curve steepening. And so it ends up being that you don't want any hedge. You just want to own the thing outright.
Right. Yeah. Well, so that's a great thought process, right? Like, first of all, when you're a proper bond bull, there's nothing wrong with just buying the IVOL product outright, right? Like,
yeah, that's exactly.
And then what you could do is you can put different derivative hedges to one manner or another associated with it to protect the bond component, while you have the optionality of all these steepener options inside there, right?
Right, and you in essence are getting exposure to an institutional level product and an institutional level manager that usually retailers can't do. It's a great product.
Love it.
Huge
love
fan.
It.
Yeah.
All right, let's move on. So let's jump into tales from the trading desk, and we're digging one up from one of your past pieces.
Posts.
Right?
Yeah, my posts. So it's actually damn, I wish I traded that. And it's I used to have this series that I would write, and it was actually inspired from a musician that was a disc jockey on a Toronto radio station, and he would have a story where he would tell a story, mention a song and tell the story of the song, and then he'd finish it with "Damn, I wish I wrote that." So I made "Damn, I wish I traded that," and let's go back to 1987. Yeah. And everyone knows George Soros now, but back then he was hardly somebody that the average Joe would know about. It was only he was an elite trader that basically unknown except to the few that traded with the hedge funds. But he still traded in size. And one of the things was, as 87 rolled around, he became convinced that there was going to be a crash in the stock market. The trouble is that he thought the crash was going to emanate out of Japan. Wow. And so he went out and he put on a monster short Nikkei, long S&P futures position. So think about that. In 87, wow. he straps that on, and everything's looking.
The Nikkei didn't really blow out until in 89.
89. Right? You're absolutely right. So if you look at it, the Nikkei outperformed the S&P huge. But the interesting part about it was when the 87 crash came along, you can see, we'll pull up this chart of the 5-minute chart. You can see how violent the move was. Most people think about it and they think, oh, it wasn't that bad. But you'll see that the Friday, the contract was down 5%. And I remember reading stories of people saying that they were celebrating because they thought that the long-awaited correction was over. And then come Monday morning, it gapped down. And at that point, it was looking a little scary.
Right.
But the real pain was still to come. So Friday, it had started the day at 300. It closed at 280. This is the S&P 500. On Monday, it gaps down to 270. and then closes the day at 200.
Wow.
Think about that. So like that's like a monster.
So
move.
just add zeros on that to put in today's perspective. 2,700 down to 2,000.
You're absolutely right.
Right. Like
You're
just
absolutely right because
like it would be like the equivalent of a 700-point S&P crash in one day. One day.
Yeah.
Unbelievable.
And then what happened was it bounced and it gapped higher and then made another new low. But then it finished kind of unchanged. Wednesday, things improved. It gapped higher. It closed. It grinded its way back up. And it opened on Wednesday. It was at 260. And this is where the story of George Soros comes into play. Because on that Thursday, he's having trouble making margin calls.
He's a high roller.
He's a high roller. Because
Like,
don't forget as well that back then,
Paul
stocks
Tudor
were...
Jones style, right?
No, but they were 5-day settlement.
Okay, yeah.
So I'm going to read you a little bit of this book that I love. I found this book when I was a teenager. It's called Black Monday by Tim Metz, and I just love it. Anyways, it was one of the stories they told in there. It was from a Chicago trader that had a ringside seat for the S&P pit. Right. Anyway, so he says, I'm just going to kind of paraphrase a few bunch here. It's October 22nd, 1987. The Chicago Mercantile Exchange floor at 9:30 a.m. So he says, the word is spread everywhere at the CME this morning that Shearson, Lehman Brothers, plans to sell thousands of cars on today's opening. They call them cars at the CME, but it's really, those are contracts, okay? Scott Surfling, which is basically the author or the trader in the author's story, almost stayed too long in his upstairs office and needed to run down to the elevator to make the trading desk on time. But he is here now, and today's opening will be burned in his memory. Shearson's floor broker offered 6,000 cars on the opening. Nobody would say anything. Finally, he got a bid of 198, down 60 points from Wednesday's close, and he took it. Then he sold 8,000 more cars in the first minute of trading. It had cost them $300 million to do that. And then in another minute and a half, the price was back up to 230. Okay. Wow. Apparently, it became known in the pit that there was a large customer order to sell several thousand contracts. And given the uncertainty in the market, many of the locals backed away. However, beginning suddenly at 9:30, the futures began to rally sharply, reaching the 230 level within 3 minutes. Approximately 2 hours later, the S&P 500 futures were back above 250. It was an instant 24% decline, followed by a 28% rally in 2 hours. Goldman Sachs bought some of the contracts at the opening. Bob Rubin, the firm's top trading official, will confirm. So did Shearson, acting for its own account, another official will confirm. I was mad as hell when I found out it was one of our own customer sales, he would add. The seller was high-stakes Wall Street investor George Soros. You ought to talk to George about that trade if he'll talk to you, Rubin suggested. But attempts to reach Soros will be unavailing. The incredible bust will be a miracle that changes the life of one of Surfling's colleagues, who on Wednesday mistakenly neglected to close out a short position of 25 cars. The mistake could have been a disaster if the market had opened sharply higher. Instead, the price break caused by Shearson's selling will let him buy the 25 contracts he needs at less than 200, giving him a profit of 700 to 800 grand. I only knew him by the badge number, and he wouldn't talk about it. He just walked out of the pit, sold his seat, and he hasn't been seen back on the floor since that day.
Thank you, George Soros, right?
Yeah.
We talk about him and his famous, breaking the Bank of England, but you know what? It comes around, goes around. A big trader can take a hit just as easily as he can walk away with $1 billion, right?
Yeah, it's crazy. And it's just it's a really interesting story. And there's like a lot of people, if you talk to them, if they were at the S&P pit at that time, that is a very famous kind of opening. And it was probably one of the most dramatic and mispriced openings in the history of the S&P 500.
Right.
And Soros had his face ripped off.
Ripped off is an understatement.
Yeah.
All right. Well, thanks for sharing that, Kev. All right, it's time to move on. So, hey, this week in trading history, I'm actually very, very happy to be talking about this one. I was waiting for this one. This has been circled in my calendar for a couple months now. And let's talk Guinness. I mean, we love our beer on this show, right, Kev?
For sure.
And so I thought this was just a great tribute to pay. Now, when I started reading this, I was like shocked. Actually, I didn't realize the rich history of this company. So originally, Arthur Guinness started a company called St. James Gate Brewery back in Ireland in 1759. And then it was by 1838, the company proceeded to become the largest brewery in Ireland. And I'm not actually sure when they changed their name to Guinness from St. James. But it was later on in 1886. 1886, just to put it in context, 10 years before even General Electric was listed.
Wow.
Right?
That's,
1886,
yeah.
it IPO'd. It was the world's largest brewery back then.
Wow.
And so it basically soared from 350,000 barrels of beer to by 1868, 779 barrels, and then by 1886, when it was IPOing, they were brewing almost 1.2 million barrels of beer a year.
Wow.
Like, it was incredible. And so the IPO of Guinness was Arthur Guinness's grandson, Edward, said he wanted out, and he sold his 65% stake in the company in an initial public offering for £6 million, which the equivalent of, let's say, I think today's value is about $321 billion in today's dollars.
Wow.
Right?
That's unbelievable.
That's unbelievable, right? And so on its opening IPO day back then, it soared 60%. Like if it was a tech stock. Right?
That guy that's complaining,
unicorn.
that tech guy from the tech VC that's going around complaining about all the opening prices and all the value lost the companies aren't achieving, he would have been really pissed at that.
Yeah.
Yeah.
He would have been pissed. What's interesting is that a couple of interesting notes. Like one, the brewery refused to advertise or offer their beer at a discount. So they became the largest brewer in spite of never discounting and rarely advertising. So
They
it's
were
just
the Apple of their day.
Yeah. And they owned no public houses because a lot of the breweries in England would own the public houses to make sure that they had the control of the supply chain. And the company at the time was like 20 times oversubscribed when it made that 60% run. So it was pretty cool. But a couple little interesting tidbits of history following that. So in 1986, exactly 100 years later, they tried to acquire Distillers Company, or they did, and it led to a scandal and a criminal trial, basically suggesting that the share price of Guinness was engineered higher by the chairman for the takeover bid. And they had there's some sort of lawsuit for like £5.2 million or something like that that happened, and eventually about 11 years later in 1997 it merged with Grand Metropolitan to form Diageo, which is the company we know today as in which Guinness is thing. But Guinness from 1886 was a publicly traded company. I didn't know that until I read this. It's a pretty interesting story, isn't it?
For sure. I have a couple of Guinness stories to tell, just quickly. First of all, when I was in Ireland, I took the family there. And when you take, you're in Ireland, they let everybody drink. So I was up at the top after the whole tour of the place. I think my son was 8 or 7, and I'm proud to say, had his first beer, which was a Guinness.
Nice.
He said he was disgusting, and I said, it's your first beer, but it's probably not going to be your last. And then the other thing is we went to Galway, and then north of Galway, there's a place called Ashford Castle. And Ashford Castle was actually one of the homes of the Guinness family. And it's Patrick, it's awesome. It's basically my wife and I, we had such a great time there. You feel like you're in Downton Abbey. You can walk to the town. It's just unbelievably nice. I think it was rated one of the top hotels in the world. That we were there before it was renovated. So when I could still afford to go there, we probably can't anymore. We went, listen to this, we went falconing.
Really?
Like, I shit you not. We took the kids out. We all got a hawk on our arm, and we went out and went falconing. How straight is that?
That is pretty cool. So what does that involve? What is this bird like? What do you do with the birds?
You put the bird on your thing, and then you just send them off into the forest, and then you put it back where you get a little piece of meat, and he comes back. It's not like really.
It wasn't going hunting or anything.
No, we didn't actually use him to go hunting. We just flew him around.
That's pretty cool.
But the cool thing about the story is that the Ashford Castle was owned by the Guinness family, and then. I think they inherited in 1868 or some crazy number. Like, they'd owned it for a long time. And then what happened was World War II came, and guess what they did? They pitched it.
Really?
They panicked. They sold it.
Wow.
I think they sold it for almost like nothing. They thought that it wasn't gonna, either they were worried about the war or whatever it was. But it's, we have a place in Toronto that was also, it's Casa Loma. It's the same story. It was built right before the Great Depression, and the owner just gave it back to the city. And this was almost the same story, I believe.
Wow.
Anyways, Google it. Ashford Castle, great place. Patrick, thanks for the story.
Yeah.
Guinness, thanks for the beer.
Yeah, no, this is a delicious beer to have for the show this week. All right, so let's move on. So, Kev.
Yeah.
Normally, and I'm sure many of our listeners' disappointment, where we normally feature the WTF video, we don't have one this week, Kev.
I know.
What
I fell down.
So on our screen we have what's called the trading couch, and it was a part of that was supposed to be a part of our show that one day we might even bring back, but it's our little therapy dog. And this is where we pick your brain. So, Kev, what happened, buddy? I'll tell you what happened.
What?
You were too busy with more important things.
Well, that's true. Anybody that tells you they can't work out, they don't have time, everyone has the same amount of time. They're not allocating their time correctly. So at the end of the day,
you failed to allocate your time.
I chose to put other things ahead of the WTF video.
Well, you know Patrick. What? I hope that all of our listeners reach out to you on Twitter and stuff like that and give you shame for disappointing everybody.
Shame! I'm like Cersei going naked down the street. You don't want to see that, though. You don't want to see that.
No.
Shame.
Maybe just in those shorts from the opening clip.
Yeah, okay, that's right. Okay, let's move on.
Let's move on. So the top 5 things to watch next week. But before we do, we review what were our top 5 last week. And so those ISM numbers, boy, did they surprise. Those were ugly misses, weren't they?
Yeah, I wonder who said something about that they might be bad numbers.
Okay, fine. We'll give you some kudos. You did.
I don't want kudos. I just want you to
listen. I wasn't bullish on them. I think we're going into a recession. But you did stick your neck out and you said you think it's going south of 50, and it was. So you deserve a little bit of kudos. What I find fascinating, though, is that the market the numbers were so bad that the market is bullish because
listen, it's not quite that easy.
Bad news is good news, right?
They initially went down. We'll talk about that going forward. But no doubt about it, the ISM seems to be the numbers that have finally made it so even the most bullish of economists are saying, hey, the U.S. might not be immune to this global economic slowdown. Yeah. Number 4, Bitcoin.
Well, Bitcoin has still been dogging it. And you know what? The longer it dogs, the more likely it is to go lower. You know, as a technician, one thing I was pointing out to my members of Big Picture Trading was that, look, the bulls have a shot here. I mean, if they can get this thing north of 9,500 with some gusto, they can pull it off of the out of this kind of death spiral and put it back at least into a neutral zone. But instead, for over a week, they had a chance to rally Bitcoin, and no bulls showed up. It's just the price action is shit. All they need, it's gonna, if it gives out, I mean, we could see 6,000 on the downside. You know, and I know we all have our opinions about it, but I'm just talking about price action alone here, and the price action looks like shit.
Yeah. I like the fundamentals, and it still seems 80
You like the fundamentals, right?
No, I like the fundamentals, like analysis of it, and it still seems $8,200 overpriced. Okay, let's go on.
Yeah,
Fang.
Bitcoin's becoming not coin. Anyway, but that's Lena's little contribution there. Okay, so number 3, the Fangs. Right, and it was hilarious. One of our listeners on Twitter basically made fun of me. I was like, "We're gonna go in alphabetical order, starting with F." Loser. Anyway,
okay.
So
That's true. Well, he should make fun of me too for not catching it. Let's go.
So
Facebook.
I mean, look, all these things have been bounced in the last few days, but Facebook is still pretty weak. Apple, though, has been breaking out. Like, I mean, it looks like it wants to go. I mean, this is when you have it didn't even do a fib retracement. It consolidated sideways and is trying to make 52-week highs. Highest close, even though it traded on an intraday basis higher. Highest close in a while. I mean, if Apple here rips, I mean, this could still go to 240, 245.
It's the cherry-loving or the cherry Coke loving octogenarian that's buying it. He's pushing it to new highs.
Oh, is he?
Anyways,
but Amazon's
are,
been weak. But actually, Amazon looks a lot like the chart on Facebook. Netflix is still pretty weak. Looks pretty awful. And Google, though, is probably the next best looking chart after Apple. The other ones all look like shit. But, you know, if Google can muster up a push above 1250, then maybe it can gun for some upside. But it's a pretty mixed bunch. It is
a mixed bunch, but I will say that I would have expected more weakness out of this group this week than we got. So
really?
To me, I'm actually disappointed that they've hung in there as well as they have.
Well, come on. Okay. When the S&P's bouncing in the last 48 hours.
Yeah, but they're still, I don't know. To me, I kind of thought that they would be weaker than they are.
Yeah.
Jobs numbers. So we had those this morning.
Yeah, so the non-farm came in at 136, a little lower than expected. And the unemployment rate, though, actually was also lower. How do you make sense of all these numbers? I mean, it's just monthly prints, like, you know.
Yeah, to me, I always feel like this is the most backward-looking of them all, and everyone sits there and does all their voodoo magic. Yeah, well, yeah, that's the worst. But they do all their voodoo magic and try to read everything into it, and I kind of think that by the time that we actually get an actual slowdown, and it shows up in the jobs numbers, the market will have priced it in.
Yeah.
There's
no leading indicator benefit whatsoever to.
I would say that the average earnings, the fact that they were expected to come in at 0.2 and came in at even, is really bad. And my gut tells me that the unemployment number ticking to 2% low, 0.2% lower is just kind of a statistical crap.
Yeah.
And that realistically this was just kind of a number, and I wouldn't read anything into that, meaning any thought that this is actually a strong unemployment number report.
Right. So number 1, Kev, you take it.
Well, that's the start of the financial war with China. That was obviously a real dud, and I stopped it in its tracks by putting it in the number 1 most important thing to watch. I will say that with Trump getting in all sorts of trouble with his shenanigans, let's call them, that maybe he's busy not ramping up the rhetoric towards China, and I might even kind of suggest that he will be a little more conciliatory towards China than otherwise might have been.
Wow, that's a huge flip-flop from last week.
It's pretty mopey. It's pretty mopey. I just thought that it was important to watch. I'm surprised that I guess it's important to watch, and the real question is whether whether he's going to be able to go ahead and actually put through the policies that the hawks on his administration want him to put through, because I have no doubt that if all else being equal, that they actually want to do that to China. And I truly believe that they really do, in their heart of heart, want to put this through. I kind of view them as all Kyle Basses, ready to just shut China off immediately and live with the consequences. And the only question is Trump going to go and play ball with those guys, or is he going to try to get the economy going and goose it through some sort of deal with China?
Yep. Oh, well, it's definitely something we're going to continue to watch. All right, Kev, let's move on. Top 5 things to watch next week. And so number 5, we just wanted to ask the question, like, obviously the bad economic data drove the 2-year yield down to a fresh low. And that spurred an acceleration of the a little bit of a steepener. So the question is, in your mind, is this a legitimate change in trend, or is this just a squiggle and that's just some noise? Like, I mean, we saw, obviously we were inverted. We got up to about 15 basis points on this. We're about spot 124 now. Is this, in your mind, a chance that the real steepener is coming here and that you load up on this IVOL, or do you think that this could still be a fake out?
Well, IVOL might go up even without the real steepener going on, so that's a different story. But it's kind of, I feel a little bit like when they ask the gold guys, the gold bugs, when the gold bugs see somebody taking down gold, $50, that's always manipulation. And when gold rallies $50, that's always just price discovery, and that it's finally getting to fair value. So I'm going to take a page out of their book and say, yeah, this is great, and it's headed on its way to higher, Patrick.
All right. Well, you heard it here. Fade it. So number 4, what a little intraday reversal we had here in the last 24, 48 hours here on the S&P, Kev? Like, I mean, you and Cuppy went bearish all at once. I didn't even know what was happening. I was so confused. When the two of you guys get bearish, I'm like, is this some sort of Twilight World episode of some kind of crazy show? Like, I don't understand. You two guys are always so bullish. Well, actually, Cuppy's not always bullish, I guess.
Yeah.
But I think the fact that you both were bearish actually reversed the market.
No, because we were before that, buddy. I'll tell you one thing. So we went out drinking last night, Patrick and I, and when we were chatting, I realized that we had much different time frames in terms of what we were expecting. I had gone bearish, and I continued to be bearish, especially on a relative basis. I think that to me that the American outperformance is probably seen its last days in terms of stock market, at least for a little while, and I expect that we will see some distribution in the indices, but I definitely am not looking for a big, huge crash or even a move back down to like 2,500. Like, I'm not that bearish. I was bearish for a trade. You know me, Patrick. It's tough for me to be bearish. It's like you being bearish on bonds. You can't do it.
Hey, don't say that.
You very rarely are bearish on bonds.
Because they've been going up. When it's time to
fair.
get bearish bonds, I'll be bearish. You'll just wait. Like I'm just going to be patient and wait for my window. But anyway, the one interesting observation I was making on a number of places, whether with my members or a macro voice or whatever, I was talking about the fact that this sell-off so far has been by far, from a magnitude perspective, one of the most shallow, right? So obviously, looking at the big sell-off in September to December back last year was a 600-point drop. But even just this year, the May drop was about 230 S&P points, and then the July drop was about 250 points. And so this current sell-off in the S&P was just a very shallow 170 points. On a relative basis, if this was the reversal and it just started going higher, which I guess we can't say it's impossible that it does but it would be the weakest and the most shallow sell-off we had of all of the ones this year, and therefore I still am highly suspect that this is a fake out, and then we're going to go for another retest on the downside. I still think, like, maybe listen, I don't know whether this push is where we see something crazy like 25 or 2200, but I just don't believe that the bottom we saw 48 hours ago is going to be the low of October. I think that we still, a minimum, are going to retest it, but even go lower, and then we'll see. Maybe November, December could have a different kind of a story to it.
Well, the world's back in order. You're more bearish than I am. I'm still
thank
bearish.
God.
I think it grinds lower,
Thank
but I
God.
don't think it's going to be a big, huge swoon.
All right. So number 3, I wanted to talk energy stocks, XLE particularly, and obviously oil. I'm still kind of shocked that oil went all the way down to very close to 50. I mean, it didn't hit 50, but I just couldn't believe it gave it all back, and that caused these energy stocks to sell hard all the way back down to their lows from August. And I personally am a fan of energy stocks, and I actually think that they're stupid cheap down here. But the question we're just asking, does this low hold? Like, is that just this is a perfect buy on dip at the bottom for a retest, or does this thing still have more selling, and maybe we're going to see 54, 52, 50 on the downside of this before it becomes a compelling buy? Yeah, any opinions on this?
Yeah, it's going to hold.
Yeah, why is that?
I'm doing my best William Wallace. It's holding. I don't know.
Hold.
I just think it's gonna hold. I don't believe, like, I do believe in double bottoms. I don't believe in triple bottoms. If we go back there and test, so if we get a bounce and then it falls back down to the 55 level, then at that point I'll be like, forget it. It's not gonna hold. But at this point, I still think we could get a clean break. I mean, a clean bounce from here. I'm bullish. These things, I think they're dirt cheap. The market hates it. It just feels to me washed out. I would love it to hold. I'm not even, you know me, usually I'm trying to be cute and get all the technicians to get sucked in there before I get long. I think that this might hold, and I'm actually hoping that the voodoo magic works and that double bottoms actually exist.
All right. Number 2, I wanted to kind of get your thoughts on these semiconductors, because look, I won't lie. I've been a pessimist on semiconductors broadly.
I know. Do you know what the pisser about this is? I lost a bet on this, and you literally somehow figured out the only 3 weeks that these things have gone down. So kudos to you, buddy. Somehow you managed to time the bet perfectly.
So, with that said, we had a very, very shallow correction, which as a technician looks like a flag wedge, and with bullish gaps. Like, this chart looks like, higher lows, higher lows, higher lows, coming up to overhead resistance like almost an ascending triangle. Will this thing break out? I mean, I don't know whether we're going to Gucci it like we did with the Brazilian index, but this looks like it's winding up for a go at the upside. Does this thing go to 130?
I don't know. It's one of those go figures, because I would have never thought that it would be this strong at this point with these the fundamentals here and all the crap that from Trump and the China trade war. I guess the only thing you could say is if this thing can hang in here like
take
this,
a look at that Kospi index and all these other things. Like, you would think that these semis would be under a lot more pressure than this, and this chart looks crazy. Like, it look like. I'm always
it's bullish
because
looking.
It's very bullish looking on a chart that I want to be incredibly bearish on. I hate that.
I hear you.
Anyway.
Maybe that's why it's bullish. Everybody's wanting to hate it, and it just keeps grinding higher. It's telling you something.
Squeezed out. Yeah.
Okay. So inflation numbers.
Yeah. Like, what's going to happen next week? You called the ISM. Where are we going, buddy?
I don't see inflation for the short run.
Thank you.
Thank
you. You know what? You're actually saying something smart for once.
I just don't. I'd be shocked if we got higher numbers here. I just don't see it.
Yeah.
It's like the reality. Although I'm a huge inflation bull over the long run. I don't see how with the CRB raw industrial going lower, with that unemployment number, no inflation there, with all the uncertainty. I just don't see where we're going to get it.
There's a lot of that uncertainty. Commodity prices are still relatively weak. The U.S. dollar's relatively strong. All of those things that are usually tailwinds for inflation going higher are actually headwinds. And so the inflation number, and you know what, I'm not going to complain because we have a bet that I'm looking forward to at the end of the year cashing in. Our bet was the over-under at 1.9 on the year, wasn't it?
Yeah, I'm not looking good. I might lose that one.
You are going to potentially lose. I don't want to already do a victory lap.
Yeah,
I'm going to somehow find a way to goocher it.
For those who don't know, Patrick often likes to ring me up when I have a market call that's going wrong and rub salt in the wound. And I'll tell you, his timing is impeccable. Every single time he's done it, it has marked a short-term top in his trade. He did it on gold because I gave up on a gold long, and so he was phoning me up to tell me how happy I was. He top ticked it, and I should have gone short size because once he does that kind of stuff, it's just the kiss of death. There you go. Right. I should start a service that just tells them when you're ribbing
Jesus
me hard.
Christ.
When you're ribbing me hard. It's only when you're ribbing me hard. Somehow the market gods know. They don't like it. You should be more respectful to the gods.
I should be more respectful.
You should. It is. It's a lack of faith. That's the trouble with the young people these days. They don't believe in the market gods enough. Okay.
All right,
Let's
Kev.
go on.
All right, so give us a parting words of wisdom from James Jude.
Yeah, so from Jimmy Jude, one of my favorite guys. I convinced him to get on the Huddle. He's coming. He's an ex-CME guy, I believe. And I just love the Chicago guys. They're all these fellows that traded for their own account. They understand trading. They understand the emotional roller coaster that you go up and down. They understand how you have to adapt or you die. And that's what this post is about. I'm just going to read it. It was actually from late September. So Jimmy Jude says, I have been trading everything under the sun for 25 years. You will never hear me bitch about algos or rigged markets because the fact is, if you want to play in the big leagues, you have to be able to hit big league pitching. Figure it out. I still have to every day. I completely agree. Yeah. And I've often said this, is that everyone always says to me, oh, if only I was around when you were trading, it would have been so easy. Bullshit. The reality was it was hard then, it's hard now. And it always is hard, and it's only obvious in hindsight. And when I say there's somebody out there that's nailing it and has figured it all out, there is. You just look at Renaissance, those guys are just, they are putting up numbers that are unbelievable time and time again. Yeah. And it'll seem obvious 10 years from now, but today it doesn't. And I just like Jimmy's attitude because I think that that's what you should be having, the attitude. You got to go. It's always hard. You always have to figure it out. And you're not going to get anywhere complaining about rigged markets or algos because the reality is that if the markets are rigged, you should be able to figure out that they're rigged and make money off of it. Or if the algos are dumb, then go ahead. Take advantage of the algos that they're so dumb. And I just love that attitude. So I just thought that was a great piece of parting wisdom for us this week.
Love it. Love it.
Okay.
All right. So let's go on. So,
big thanks. We're going to wrap up here.
Yeah.
And we're going to say a big thanks to Ed.
Yeah.
Ed Harrison,
who's going to join us here in the after hours in a moment.
That's correct. But we had him actually in house. Very unusual. We need to have more of those.
Yes.
It's nice to have them face to face.
Yeah. It's easier to kind of get that rapport in there and drink some beers and have a good thing. We should do a couple of them actually in a bar. We should get a couple
for
of
sure
lapel mics.
We know what we should do. We should pick up and go to Chicago or New York and have a road trip where we do a couple of shows. Yeah, we'll figure it out. I'll try to convince my wife. Maybe Miami. In February when it's really cold.
That sounds like an awesome plan.
Okay. Well, anyways, Patrick, where can they find you, bud?
You can follow me on Twitter at Patrick Ceresna, and you can visit me on my website, bigpicturetrading.com. How about you, Kevin?
I'm at themacrotourist.com, and you can follow me at Kevin Muir on Twitter. And a big thanks to Lena and everyone for making a great show. Thanks, and we'll see you next week.
Thanks, everyone. All right, so here we are in the after hours, welcoming Ed back on. How you doing, Ed?
I'm doing good. Actually, I have a Coors Light in my hand.
Coors Light.
Yeah, I don't know if that.
My goodness.
For an American, that's good Canadian beer.
And Kev, are you sticking with the Guinness here?
Yeah, I'm sticking with the Guinness.
All right.
Your sponsor's not going to be liking that, huh?
Yeah, that's right. Of course, we're drinking nothing but Guinness.
There you go.
Yeah.
So you just you flew in from New York or from Washington? Where were you coming from?
Washington, yeah. And when I left
that where
Washington,
you-
I said, it might be cold on the plane, so I'll take this pullover with me just in case. And then when I got out of the plane, the temperature was 30 degrees lower here than it is in D.C. And so I had to take the pullover and start wearing it.
Oh, it's hilarious because actually your timing was awful because literally a few days ago I was out on the patio in a beautiful sunny day and we just got hit with a cold front that literally kicked in just the last 48 hours.
You know what? Americans never believe us when we tell them that, Patrick.
Yeah.
They're like, you should have been here a week ago. It's really warm. We could also tell them that a week ago it was snowing 3 feet in Alberta.
Yeah, that's probably
No,
right.
it
Yeah,
was.
well, actually, in the north of the States, I think it was maybe Montana. They had 3 feet.
Yeah. No, it was definitely, I think Calgary got a foot of snow. Oh, well, anyways,
All right.
it's a wonderful country we live in. It's we get the 2 months of summer and then it's winter the rest of the time.
You're making it sound so
Ah,
awful.
no, it is awesome. You know what? So I got to tell you, Ed hasn't been in Toronto for, many years. And he was talking about how it's changed so much with all the buildings. It's funny.
Well, yeah, I mean, we had an Australia-style condo boom.
Oh yeah, I mean the boom was happening 5 to 10 years ago, but it's amazing how it continues to happen. I mean, all these dead spaces being filled in, it's just unbelievable. That
Yeah.
and the number of cranes that you see, it's breathtaking.
I was telling Ed that there's more cranes in Toronto than all of the rest of North America combined.
Really?
Yep.
Even Vancouver?
Yeah, because Vancouver's small. It's still a smaller city, so Toronto is
Yeah,
definitely has a lot of cranes. I can't remember what the number is, but it's obscene.
Yeah, I'm sick and tired of being bearish. The real estate. Maybe that's the top right there. The fact that I'm tired of being bearish Canadian real estate. There, Patrick called the top right.
It's when you buy the second house to rent out. That's when I know to sell it.
There you go. So Ed, how did you get into the markets? What got you into loving this stuff?
Yeah, so originally it was that I worked at Deutsche Bank. This is like 20 years ago. I was a diplomat in the U.S. Foreign Service. I had gotten a degree in economics. I wasn't keen on that endeavor, and I had taken the entrance exams to get into business school maybe 5 years before that. My exam was going to expire, and I'd have to take it again. So I decided I'd apply to business school. So I went to business school, and when I came out, that's when I went into the markets, and I became a high yield guy. So I'm sort of a bond guy. Maybe that explains everything. Kevin was asking me about my calls on bonds and the convexity and so forth. But I guess by nature I'm a bond guy.
You know what? I can't think of a better conversation to segue into then because, you know what? I'm watching these investment grades and these high yield junk, and certainly we've seen quite a response, at least initially, on the high yields. Like, I mean, the credit spreads I think blew out from, let's say they were like 380, and now they're about 420 over Treasury, and so we've got at least a 40-50 basis point pickup. So it looks like the credit spreads are widening on junk or high yield, but you're not seeing that response on the triple Bs or any of the higher investment grade, which are still very correlated to Treasury. Is this just a typical thing that you think happens? Is it that the first thing that happens is it responds in the junk, and then eventually it'll spill over to the investment grades?
Yeah, definitely. And back to our conversation from before, my view is that when you're looking at market signals, you're definitely looking for junk. if you don't see distress, and usually when I think distress, I'm talking about defaults or restructurings in junk, then I find it hard to believe that we're going to head into a recession. So the 40 basis point out move is relatively minor by comparison to what you would expect. I mean, you should.
It just happened in a week or two.
Right.
That's the crazy thing, right?
What
It's
you
like
want
in
is,
the bigger
you want to
picture,
see like much bigger moves. Then you're going to see people, the triple C companies not have access to the market and some sort of dislocation, defaults, et cetera. And that's when you're like, oh my gosh, this thing is falling apart. And then, all of that backs up into the triple Bs and the rest of the spaces.
So you saw that actually.
Correct me if I'm wrong.
One second, I saw. Sorry, Patrick, I didn't mean to step over you there, but I saw that Apollo was having trouble doing their bank loan for the Shutterfly acquisition. I'm wondering if we're actually going to see it in different parts of the market, and it might be in the bank loans that it originates, and especially the private equity side. Because we haven't talked about this, but I think the whole kind of bloom coming off the rose of mark your private equity book to wherever you want to market is upon us.
Yeah, that does make sense because of the collateralized loan obligations. The whole leveraged loan space is getting, it's as frothy as any other part of the markets, the public markets. And when you talk about the private markets, I think about in particular WeWork and how WeWork and also Peloton are a denouement for private markets on the equity side in terms of what's the end game for these companies. If they don't have an end game, then people have to rethink what they're doing in those markets. So all of those things are coming together at the same time. You really need sort of a trigger for a gap out, and then the distressed companies, the ones who are basically Ponzi. If you think about it in terms of Hyman Minsky, he talks about Ponzi investors. That is people who really need to roll over their investments for it to work. WeWork is essentially a Ponzi investment. That is that they're really they're expecting so much growth that they can't sustain what they're doing unless they get more money. If they don't get the IPO, if they don't get the bank loans that Kevin's talking about, their goose is cooked. So if they go bankrupt, that could be sort of a trigger right there.
The one thing. Okay, so that's WeWork is a blatantly obvious one, but let's talk about some of the whales because I don't consider WeWork a whale. But from a fallen angel perspective, Ford got the downgrade, didn't they? And GE's on the bubble. What's your take on these big corporations that are like at the edges of the cliff here for that downgrade? What's your thinking? Do they get all downgraded? Is this cause a dislocation in the high yield market?
Well, I was talking to a guy who is the head researcher at one of the European banks in high yield, who's a friend of mine, when I was in London about 2 weeks ago. And we were talking about it. So if and when that does happen, the biggest problem basically is the absorption of those funds, first and foremost. Secondly is also the fact that when they get downgraded, there's only a certain amount in an index that you can have for any one particular company. So let's say GE gets downgraded. The amount of outstanding debt or of AT&T is greater than the specific percentage amount that any indexed investor would want for them. So you have a problem right there.
Yeah.
The question is, how do you get from here to there? And I think that this is sort of a derivative event, as in I don't see the ratings agencies triggering the event. I see bad things happening in the real economy and with other companies first, and then the ratings agencies being forced to abdicate their triple B status for these companies. And remember, in order for them to really be high yield, every single ratings agency has to put them down. So if S&P has them at double B, and Moody's has them at triple B, that's not high yield.
Right. So Ed, I was talking to a really smart kind of distressed and hedge fund guy the other day, and I was kind of shooting the shit about his about Rosenberg's theory about the high number of double Bs and triple Bs, and the fact that they will CFOs and treasurers and CEOs would do everything they could to protect that that kind of rating, and therefore they would stop buybacks and they would stop capex before they let their bonds shift into that kind of high yield category. And this fellow is like, that's like he had a great, really smart response, and it kind of dovetails very nicely to what you were saying, because he said something to the effect that that's all great, and you know what? Yes, in a kind of an environment when everything's going around nice and stably, like that is something that they would do. But once the recession hits, the ability of Ford or of GE of cutting enough capex or cutting enough buybacks to actually skate them outside of this is almost nil. And he basically argued it doesn't matter when the real economy goes into the ringer. These things are going to very quickly be high yield, and the market's not going to be able to handle it.
Yeah, I'd agree with that. I'd say that, Rosenberg is probably soft pedaling his real view. His real view is probably more bearish than the view that he espouses in
Rosenberg,
not
bearish?
Rosenberg.
Come on, not a chance. Yeah, no, he is probably, you're right, soft pedaling it. But I think his argument was that it was actually more that triple B argument is actually more economy bearish and stock market bearish than bond bearish. And maybe that was because he was at a Gluskin Chef and it was a bond shop.
Right. So yeah, let's talk about the bond bearishness, because we were talking about that as we opened up your Guinness earlier, and my talk about the convexity when you get down is talking about going down to zero. We're talking about going from 1.5% down to zero. What happens once you get to zero? That's the big question,
Well, that's assuming you get there. I'm actually, as you know, a little bit of a bond bear. I think we're going to get the fiscal stimulus that we're looking for. I think it's coming. But if I'm wrong, I completely agree that if the Fed is late in cutting and if the fiscal is late in coming, then you're right. The bond bulls will be right, and it'll be a shit show. Like it really will, and it'll.
Kev,
sorry.
You've always you listen. You're just really forward thinking, and you're like realizing the problem's going to happen 5 years from now, and you're just way too early, as always.
That's what my wife says.
Yeah, and that's exactly what your wife always says. That's how I know.
Okay.
But
what my wife told you?
My wife told me.
Okay, let's just go. Keep going, Patrick. Sorry.
No. But I just think that it really comes down to that it's very. I don't know. Maybe this time around there could be that catastrophic event where stocks and bonds go down together. I just personally don't. I'm not in that camp, right? Like I think that this plays out somewhat more textbook, where there's going to be a safe haven element to bonds. Maybe it's not going to be at the longest end of the curve where the action will be, but certainly on the short end we'll have some safe haven element to these bonds.
Well, I think Ed though is arguing that there's going to be a convexity squeeze and a chase for duration, and in fact the curve could probably the long end might go faster when it really comes down to it. I think there's something in the water, Real Vision. I think it makes you a bond bull and a gold bull. Like I think it's like, or maybe they're self-selecting that when they're like hiring there, they're like, are you bond bullish? And do you think bonds are going to 0% yield and gold going to 4,000? Great, you're hired. What do you think, Ed? Do you guys do that?
Yeah, like that's the thing is actually, it's funny because when I was in the Foreign Service, we took this Myers-Briggs thing, and they asked us what our to raise your hand if you're like when you got your Myers-Briggs profile back, and like 3/4 of the room raised their hand when they answered one particular question. And then the question becomes, is it because of the work that you do that you have that personality profile, or are people just hiring people just like them because they're like, oh yeah, this guy, he's just like me, so let's hire him on.
So what's the answer?
I don't know. I think that I think most people actually don't want to hear the other side of the story. This confirmation bias. So maybe that has something to do with it.
So do you think the confirmation bias now, though, is at a point where it's on the bull side, or do you think it's the other way?
I think that people are going to be dragged kicking and screaming toward a bond bull case, in the sense that the closer you get to zero, the fewer people see upside for bonds. It's just like with Europe. Once you got down towards zero, people were like, what are you going to do then? I mean, that's what I'm asking right now. What are we going to do when we get to zero? Now, the Europeans have already told us. We know it doesn't work, but they went, they've gone to -1%. So, I think that the concept that you can't squeeze some more juice out of that squeeze is false. You can. There's more to be had.
Okay, so I'm going to change the topic a little bit, because I know that deep down in your heart, you're actually sympathetic to a theory that I also use in my analysis, and that's MMT. I think that if we looked at it, most MMT practitioners would say what they're doing in Europe is absolutely insane, right, and that it doesn't work, and would have a very different kind of prescription to how to fix it. Do you think that first of all, do you agree that it is insane, and that they're going down a road of trying to do more and more monetary stimulus is never going to work, and that the reality is that they have to wake up to how the modern fiat system works? And if so, when do you think that's going to happen? Is it going to take an actual crisis in Europe before we get the fiscal that we probably need?
Well, I'm going to be the devil's advocate here, and I'm going in my mind how I want to answer this question, and I'm going through a lot of different scenarios. And here's what I've come up with is that if you look at Japan and how they dealt with their crisis from years ago, and at various points they decided to cut the deficit, and they hiked up taxes and ended up with these recessions and so forth. That was all self-inflicted. The Europeans are following the same script, except it's not self-inflicted, as in it's self-inflicted only to the degree that they set the euro up in a way that ties their hand. They said, we want to have our hands so tied that we can't do anything. So they've created a scenario in which monetary policy is the only game in town, because all of the rules say fiscal, you can't do it. I mean, look at this. I mean, Italy, which is the country that has the most problems, they're running a deficit which is lower than the 3% hurdle. And if they go over that amount, let's say they go to 2.5% debt to government debt to GDP, or a government deficit, that's wrong. They will be penalized for that. Why? Because all the numbers work out so that it's too much debt that's being added on at that percentage rate, et cetera. So they have to have a surplus, net of interest. It's crazy stuff. I mean, that's the system that they've set up.
So we agree it's crazy, and we agree it's self-imposed. But, and everyone tells me, there's rules and stuff like that. There was rules in the U.S. as well that they couldn't go do TARP and stuff like that. I think it's dumb to make it an investment based upon the idea that the rules set up are set up by humans, that we aren't going to figure out a way around them, like whether it be just a technicality to figure out a way for them to spend. But I just think that as they wake up to how dumb the rules are, they're going to change them. Because it's not a real scenario where interest rates really should be negative, 150 basis points or whatever it is in Sweden. I mean, Switzerland. It's kind of it's ridiculous. And I think to assume that we're going to stay bound in this kind of self-defeating pain loop is just a dumb investment strategy. What do you think of that?
Well, it's interesting you mentioned Switzerland because, yeah, it's for Switzerland. I mean, they have degrees of freedom that the Eurozone doesn't have. So it is kind of interesting that they're leading the charge. They have the lowest rates. I would say that I would look at the Great Depression, and I would look at the Netherlands in particular as sort of a thinking about how this works. If you look at the gold standard and the Great Depression, basically the gold, the Eurozone's basically a gold standard, and people did not want to get rid of their peg. And so they just, slogged it out and they went into a depression. And the last man standing was the Netherlands. And they were the ones who did the worst. They inflicted the most harm. So the last people who came off the gold standard, who devalued, they got hurt the most. So I think that's what's going to happen. And the answer, therefore, to your question, from my perspective, is you have to see the crisis first, and the crisis has to be bad, and then you're going to get the response.
Well, so I think that's a great analogy, and I've used that before, the idea of the gold standard, and I've always said that it's bar rule fights apply, and that's basically you hit hard and you hit first. Because when you go look at the people that went off the gold standard, you'll see that the ones that went off first did the best. And so maybe you're right. Maybe it's not Europe, but I just wonder when a Japan or somebody figures out, maybe even it's Canada or somebody out of the blue figures out, hey, listen, trying to solve a slowdown in the economy with more monetary policy, more monetary stimulus is just a folly, and that when they start to realize that they should do fiscal and it actually does well, just like what happened in the U.S., because I would argue that Trump is the most MMT president we've ever had, I think it's going to go, the dominoes will fall quicker than everyone expects.
It's interesting, what's going on in Europe now, and Draghi is basically saying, he's finally saying basically what Bernanke and Yellen were saying. It's all fiscal. We're doing as much as we can. You guys have to do your thing. And then even people like Schäuble are saying, okay, you're right. We need to do more. So then the question becomes, do they do more before the crisis hits, or do they wait? So I think we're on the same page that something's going to happen. The question is when is it going to happen? And at this point, I'm still fairly negative on it's happening in due course. I feel like they're gonna wait too long, and the thing's gonna ravel out of control, and they're gonna have to cobble together a crisis response.
Okay, so you mentioned Germany, and we're going to go a little off topic here because I think I remember you telling me you lived there, right? Is that correct? So one of my buddies told me that Oktoberfest is literally the best, few days that you can have, bar none, throughout all the world. So I want to know, is this correct?
I don't know. It's funny. My sister-in-law, ex-sister-in-law actually, is German, and she's from Cologne, and she went down to Oktoberfest. And Oktoberfest is in Munich and Bavaria and so forth. And in Bavaria, they call everyone there Prussians. If you're not from Bavaria, then you're a Prussian. And they speak this dialect, which is totally incomprehensible to normal German people. And she was like, she went to Oktoberfest, and she was like, can I get a little beer? And they looked at her, because they have these massive 32-ounce beers, and that's all they sell. And they said in some sort, in their dialect, they were like, "Was bist du Durst hast and drink some Mass," which basically means wait until you're thirsty and then drink a Mass, which is the 32-ounce beer. So they would not give her a 16-ounce beer. They were like, "That's sacrilege." So there you have it.
Awesome.
It is a great place to be. If you like drinking beer, you will like Oktoberfest.
We have to. So, Patrick, don't you think we have to have the Market Huddle in the Oktoberfest edition?
I already did the scouting. I actually 3 years back, I think 2015. I did the Oktoberfest out there in Germany.
You went?
Actually made the.
You were there. I didn't know that.
I was. I did, and I sat in the beer tent and got plastered. It was
Patrick. That's just a Wednesday for you, buddy.
That's. I got Wednesday plastered.
Yeah,
You know, but
and
it
unless
was-
you're like a Brit who likes his warm beer, that means you when you're getting a 32-ounce beer, you've got to be drinking quickly. Otherwise, you're drinking warm beer.
Oh no! What's even worse though is that you can't get seats, and so we actually got there 7 a.m. in the morning to ensure we got a table, and so we were drinking by 10 a.m. and we stayed there the whole day, and we're drinking it by the liter. Like it was nuts.
Patrick,
Like,
again, that's
I-
just a Wednesday for you.
Did you have your lederhosen on though?
Yes, I did. It's a good story about that because it was here in Toronto where this German guy. I went on Kijiji and I was like, I got to find myself some authentic ones. So I found these like 40-year-old proper leather lederhosens, and I basically went and bought these things. Bought it for like $50 or something like this, so used. And yeah, so I had them on. It was awesome. Like they were the authentic ones. It was awesome. I tried to go all the way.
Maybe did people start coming up to you and start speaking to you in German because they were like, "This guy's the real deal right here."
Oh no, they knew because I was with a bunch of mungie cakes. So that's there's
That's not the German word, buddy. I hate to tell you
no,
this.
that's not the German word. That's
Yeah.
But it gets the point across. There was no hiding the fact that I wasn't a local.
Oh, that's funny.
But it was a good time. No, it's definitely a trip worth making. We should have a huddle.
We should have because I've never been. You two have obviously been, and I'm missing out. And I have to go. I have to check this out.
Oh, it's a great time. Great
Yeah.
time. So what's it called? So yeah, it's what else are we going to talk about?
Well, so Ed, you got to tell us what you think about the Canadian economy. Like, are you worried about? We were chatting a little bit about the.
How about our Canadian Prime Minister?
Oh yeah, wait. Let's talk about the Canadian Prime Minister.
Do Americans even know anything about Canada?
That's right.
Yeah, I mean,
You guys have a GDP.
I'm speaking to Kevin tomorrow. He's going to tell me all about Canada. You're going to tell me all
I don't know.
about the Canadian economy, what's going on.
My
what's going on here right
my
now.
opinion in a subway token might get us home tonight. Do you know the one thing I do know about Americans is that I was shocked one time I saw a stat about how many had been to Canada, and it's an exceptionally low number.
Oh yeah, I knew you were going to say that. I was wondering when you said that which way you were going to go. Is it exceptionally high or low? But I knew it was going to be low. I bet you more Americans have been to Mexico than they've been to Canada.
I think you're right. And then like you go the other way, and Canadians, like I don't know if I know anybody that hasn't been to America. Like
two things about that. Like I saw a stat that 90% or something like that of Canadians live within 100 kilometers of the border. And then the second thing is I remember when my son was young, we went on this vacation in Canada, and it was really far up in Ontario, and we were coming north. And when we hit the border and we were in Canada, it was just like I could go 100 miles an hour if I wanted to because everyone was going south. It was like a traffic jam in the other direction. There was no one going north. We were like these crazy Americans who were coming
fools going north?
Who is that crazy guy? So I have to ask, where were you going? You made it sound like you're going to Northern Ontario, and I have this feeling that you're going
to Keith McCullough
It's
land.
going to be like he went to Barrie. Like it's going to be somewhere you didn't go far. Where did you go?
Yeah, that's right. I think that we probably did go to something like Barrie. I think it's close enough. But have you ever heard of Santa's Village?
Oh yeah, Bracebridge. Been there lots of time with my kids.
So there you go. So we were in a resort in that area.
Oh my goodness, you drove miles and miles to go to Santa's Village. Holy smokes!
We had like a 5-year-old or 6-year-old. He loved it. He was like, because Canada and Santa, come on.
Yeah, in the middle of summer, it's great. Like, it makes all the sense in the world. Santa's Village in the middle of summer in Muskoka. That's basically it. It's actually a lovely place, and it's a lot of fun. But that's funny. So you were an hour and a half outside of Toronto. That's how far north you went. Maybe It was 2 hours. Maybe 2 hours. It was not. We had. Shaylin on last week, and he started telling this story about how he went to the most crazy, desolate part of Canada, and it was like an hour south of Calgary, and I was like, dude, that is not desolate Canada, right? Like when you go and you're worried about not filling up for gas because you don't know when the next one is, then you'll know that you're in desolate Canada.
Yeah.
Well, I was in desolate Canada once. I went to this place, Fernie, in British Columbia.
Oh my God, that's where Shaylin was. That is not desolate Canada.
It was desolate. I'll tell you why. Because so I get to Calgary, I get off at the airport. These guys, they tell me they do not have my car, but do I want a Ford Mustang instead? And I was like, hell yeah, I want a Ford Mustang. So
in February, right?
No. This is like the middle of summer.
Oh,
it's
it
like
is summer.
June or something
Okay,
like
yeah,
that.
yeah.
Okay, so I'm in this Ford Mustang. It's probably like 5 or 6 or something like that. So there's light all around. And, I'm going in Alberta and BC, and I can see the stream and the mountains in the background. I'm just like, I love this. Canada's the best. It's amazing. So then I get near to where Fernie is, and when I get there, suddenly we're at this resort or this retreat that we're doing. I have to go up this mountain. It's like an unpaved road in this Ford Mustang, and suddenly out of nowhere these moose come coming at me. I'm wearing a suit and a Mustang. I'm just like, I have no cell phone service. I'm thinking to myself, if this moose like gores my car, what's gonna happen? What's gonna happen to me? This is.
Oh, you should have had
I'm
me
an
there.
East Coast kind of guy. I'm not built for this kind of stuff.
So
And
first,
then, by the way, when we got up to the top,
yeah.
of this mountain, literally, this was June. In the morning when we woke up, it was like 35 degrees.
Oh, that's Fahrenheit for the Canadians that are listening. that he means Fahrenheit, which means it's like 2 or 3.
Two degrees.
So first of all, a couple of things I'd like to say about that. Too bad you didn't have Patrick. He would have shot the moose for you. And then the second thing is they do not core your car.
Well, he was coming right at me.
I know, but he doesn't want to hit you. He wants to get away from you. Were you going to Island Lake Lodge? Was that where you were going?
Oh, what's the name of the lodge again?
Island Lake Lodge.
Yes, I think
Yeah,
that's
that was it. I skied there in the winter, and they turn it in the summer, and I've been on that road, and it's very nice.
And they have those little rooms. It's like very rustic.
Yeah, and it's like a log cabin and stuff like that. Yeah,
exactly. Yeah, that's the place.
I skied there for sure. It was one of the we go cat skiing every year, and that was one of the years we went to there, and so. It's actually some great skiing. Unfortunately, it's a little bit too south, and so you don't get as consistent weather as like when we go like north. You went south from Calgary. Usually we go north and we go into the mountains more. And so, anyways, it's a lovely place. It's good food actually, and it was a lot of fun. So, what were you there like on a corporate retreat?
Yeah, I was. I used to be a consultant, so I was giving a talk to people from. I can't remember. Maybe it was the Canadian Railroads who I was talking to at that time. Because when I was a consultant, I used to do lots of Canadian companies, and I came to Toronto probably like 10 or 15 times and talked to different companies here, and I talked to companies in Vancouver and in Calgary and so forth.
I'm just getting in trouble on the overhead because they're telling me I'm slurring into the mic, so I'm just.
All those Guinness,
Yeah.
I have a great story about Guinness when I was in Spain.
Okay.
One thing that you don't know about Guinness is it's a slow pour. Is that so? We had this we were in Spain. This is when I was in college, and at this local bar, I think it was like Thursday or something like that, they had a Guinness night, and if whoever drank the most pints of Guinness could get the Guinness for free.
Oh.
The key, however, was because we were used to doing it American style, just like downing it, is that they would pour the Guinness in straight up. So when they poured it in, like it would foam up to the top, and then they had this like this paddle or whatever you call it, this wooden thing, and they would scoop off the excess, and then they would pour it more and more. So by the time you got your second beer, you were already starting to get full from the first, and then the third would come, and it would be like 10 minutes later, and so this just went on. And the guy who won, he was actually from my college, because we drank a lot apparently. He drank like nine pints. That's all he could do.
When you were telling that story, I was thinking about that famous economics problem where you put people in a room, and it's like something where the person that pays the most will win the like $100 or something. But then, what happens is people, if you bid and you don't win, you have to give the money in. So people go and they keep bidding higher and higher, and it ends up being that the winning bid is often through the value of the prize. So I was thinking about that when you were talking about the whoever drinks the most, is that at a certain point you got to just go for it. You're like, I don't want to pay for this, so you got to double down and try to beat everybody else.
That's exactly what happened. I think that the losers they had like eight pints that they had to pay for.
It's a great marketing strategy, actually. It might not be legal. Yeah. It probably is in Ireland because everything's legal there. But but it's a great marketing strategy.
Well, it's a great marketing strategy for Guinness. I mean, we were in this town in Spain, Salamanca, and Guinness was being marketed, and this was like years and years ago.
Oh, that's a great story. That's terrific. So, Patrick, I think we're going to head out for dinner, buddy. I think we should call it a night, and you should come on and join us.
That sounds like a plan. I'm heading over.
Okay. Just a big thanks. Let's let Ed plug his stuff one last time. Sure. People tell where you can find it. And listen, I didn't say anything last time, but Ed put me on his stuff on his email, his letter, and I said I kind of wrote to him and I said I wish I could write half as well as you do, because there's some really terrific writing and it's some really great thinking, and I really suggest that everybody goes and have a look at it, and at the very least sign up for the free one because it's a terrific service. Anyways, thank you for being on, Ed. Why don't you tell everyone where you can find you?
Thanks for that, Kevin. They can go on to creditwritdowns.com or www.creditwritdowns.com is where they can sign up for the free one, and look forward to talking. Maybe I'll have something to say about this conversation that we had in my next newsletter.
Thanks again, Ed.
If I remember.
That's right. Thanks again, bud.
Take care.
Oh, thanks a lot, Ed.
Okay, bye-bye.
It's a pleasure.
Okay, Lena, hop on.
What's
Lena,
so funny, Lena?
I'm just
Lena's
laughing
looking
at
at
this picture.
The official Market Huddle menswear.
Yes.
For
I'm
those that are
glad
just
that you didn't put
listening
up
only.
official Market Huddle women's wear also.
No,
I
can't
don't know
do
what
that.
that's going to look like.
I'm very good with that, Lena. Have you ever seen me do a picture? I'm very, very aware of that. I stay very away from that line.
Look at these guys' shorts, though. They're so short. They're shorter than my shorts.
Yeah. So those that are listening, we actually have a picture from, it's got to be a long time ago, because the reality is
early 70s.
They're selling men's short and long sleeve business shirts for $2.99.
That's what Ron Burgundy's
$2.99
wearing behind his desk.
Yeah.
When you say $2.99, everyone's thinking $299. No.
Yeah, I'm sorry. $2.99. But these guys are rocking short shorts and short sleeve shirts.
Baby blue.
Big, huge
shorts with belts
big, huge
on.
wide tides. And then the best part about it is dress shoes with high socks. It is such a great look.
It's like, who wears short shorts?
Oh, I have those. Tom Selleck style.
But
Mrs. Macrotourist asked me to wear them.
But look at what it says here. Fashion ties, $3.99 each. Prints and woven designs. Look smart in a Target tie.
Oh.
Do these guys look smart in this picture?
I wonder if this is from Target. When did
Must
Target?
be.
'Cause that's awesome. I didn't realize that.
And walk socks, 99 cents.
Walk socks.
That's right. Not all socks are made
I
for
think we
walking.
should get that ensemble for ourselves, right?
Well, Lena had a great idea. Lena, why don't you tell everyone what your suggestion was earlier?
Well, whenever you guys make a bet, it's either a burger or a steak dinner of some sort of food-related prize, I guess you could call it. I think one of you, whoever loses a bet, should wear the full ensemble in this picture.
I agree. I'm in. The next bet is going to be this.
Yeah.
Oh
They got to go find it. They got to go try to recreate it.
People that are listening needs to go see this picture at least.
It's awesome.
This is pretty awesome.
Yeah. No, it is awesome.
Oh my God! I'm not. Then I got to make a bet that I'm not gonna lose.
What are the chances of that?
It's pretty hard. I'm gonna have to be waiting for a while.
So anyway, we'll do that for sure.
How about the beer?
Oh yeah, sorry.
Need we say more? It's Guinness. Do we even
Yeah,
need
I
to
know.
rate
It's
it?
like we don't have to-
I'm gonna give it a 9.5. It's one of my favorite beers. I'm not gonna.
honestly,
I'm not
you're
gonna
giving it a 9.5. Wow,
Dude, it's one of my favorite beers. I'm like almost
But it's not a
always
sour.
have
yeah.
some. That's
I'm
okay.
gonna go. I'm
I
gonna
still-
go 8-9. I don't give out 9s easily. It's not. It's 8-9. What
It's a
did the
9.
hell is it?
You know what's? You know
You're
what's?
a 9?
Yeah, I was gonna give it a 9 as soon as we found out this is what we were drinking.
Oh, you
It's,
would
know
it's
what,
kind
though?
of hard to
judge.
give it a 10 out of 10. Like you can't give it a perfect score. But
What I will tell you is the
yeah.
most disappointing part about Guinness, because I do enjoy it so much. So honestly, I'm serious about the 9.5. Is that it only has 4.2% alcohol. So it's actually hard for me to ever get drunk on this shit.
Oh
but you'll
God.
get full really
You
fast.
smell you smell the tap and you're drunk. Like you just don't give me that crap.
Oh.
So,
No, but, like,
what the hell?
honestly-
I have a question for you. What the hell is at the bottom of my can? There's like they put a mouse or something in there.
They put like a little. I don't know what it's
It's
called. They have a little
it's
piece
a
in
for
there
nitrogen
spout,
thing,
yeah.
right?
Oh,
It's
shit.
to actually help with the foaming or whatever
Yeah.
they do. I
That's
wish
why
I
it went into
actually
my
knew what I was
lap. For those who don't know, I wasn't kidding. I literally had to stop the show because I opened it and it spread all over my lap. Now it looks like I peed myself when I head out.
Good for you. Good for you. Like, yeah, clearly you don't open Guinness cans enough.
I guess not. I'm just a knob.
Well, you have to drink it a draft instead.
Yeah.
What is that
'Kay.
drink called where they drop the shot into the Guinness?
Irish car bomb.
No,
There you go. Lena knows.
is
I
it
don't
the
know.
Irish car bomb? But isn't
The
there
one with
one
the
that,
drop of like whiskey or Bailey's or whatever into Guinness. That's like Irish car bomb.
like, all I know is like that makes complete sense because you
It
can't
is.
get drunk
Lena
on this
is-
stuff. Like
You're like our wizard. You're awesome, Lena, that you knew that.
Well, you know,
Everyone,
I
Lena's
actually have a story with Guinness. I didn't try Guinness until I was about almost 20, when I went out to Nova Scotia to Halifax on my own. I didn't know anyone there. I just wanted to go on a vacation by myself to a place I've never been. So I went to Halifax, and you know, I needed somewhere to go eat, and I didn't know where to go, and I found a little cute restaurant called Economy Shoe Shop. I don't even know if it still exists there, but I thought it was a really cool place at the time. And at night, I didn't have anywhere to go. I didn't know where to go. I didn't know anybody, so I just ended up going back to that bar night after night for like a week. Right? Like, I gotta eat something. I'm on vacation. Might as well drink something. You know, like the world was a little
Oh my
bit
God. That
different
is-
place then. And
That
the bartender was like, "Oh, Toronto girl, have you ever had an Irish car bomb?" Because I was trying different drinks night after night. I was like, "Oh, I don't think I've ever tried it." He's like, "Do you like Guinness?" And I said, "You know what? To be honest, I actually have never tried Guinness. It just seems
Oh,
a little
God.
bit overwhelming for
So
me."
you started with an Irish car bomb?
That's correct.
Oh goodness, Lena, you're our kind of gal. That's all I can
After
say.
2, I don't remember how I got back to my hotel. I don't remember, the rest of the night, basically.
Basically, it was like every other night, though. That's the problem.
Exactly. That's what's become every other night. So.
Okay, listen, I have to go because I'm actually headed to Montreal, and that is I didn't want to say it and make excuses because only losers make excuses, right? But that's why I didn't do a WTF, so I do apologize. I am headed off to Montreal. I'm about to get on a train, which I've never done, so it should be interesting. Like, I've been on trains, but I've never gone to the train to Montreal.
Right.
Have you guys done it?
I've been
yes.
to Montreal, but not
Yeah,
on
I
the
did.
train. Just on the road,
I
like
tend to
driving.
I tend to drive to Montreal because I don't like the train takes about an hour longer than it takes to drive, and you have to wait at the station for the time. And I just find that if I get in the car, I'm there quicker, and it's a straightforward drive. So I
Wow.
tend to.
I screwed up, and I was supposed to actually leave on Thursday, and then I had something else I had to do, so I had to stay in town, and I got in big trouble from Mrs. Macro Tourist, so I better not miss my train is all I can say. So everyone, thank you so much, and have a great week, and we'll see you next week.
Thanks,
Have a
everyone.
good weekend.
Take care, bye.